practical guidance on valuing your business right now. Hi, this is Josh Horn, CPA of Horn Valuation. I help owners build, value, and sell their business. This is a tough time to determine the value of a business. I've looked at some businesses that have risen 50, 60% in sales because of the benefit of COVID. I've seen some that have lost 60% of their sales because of the downside impact of COVID and related issues. I don't know whether you're on this end of the spectrum or this end or somewhere in between. In any case, it's probably going to be more of a challenge to value your business or one you intend to buy than it was a few months ago. Now let's refresh the reasons why this might be. Now there are three approaches to valuing a business. That's the asset approach, the income approach, and the market approach. Now the asset approach is simply kind of how it sounds. It's the assets at fair market value less the liabilities at fair market value. The market approach are what are sales of similar businesses in your industry? What are they selling for? And the income approach is typically based on the income or more likely the cash flows of the business. So what are the challenges here? The challenges are the market approach is much more difficult to apply because you may not be able to find transactions close to the valuation date for your business given this COVID environment we're in. So that's one challenge for that approach in particular. You may not be able to find good transactions, and if you find some transactions, do they apply to the world we're living in now? Asset approach. Well, if you're not liquidating the business, the asset approach is not really the one you want to rely on. However, I'm finding I'm using it a little bit more to set what could be the floor value of the business. Or in some cases, the business may be worth more dead than alive, so it's something I definitely take a look at. Now, where does that leave us? It leaves us with the income approach, and most notably where it leaves us is I'm having to do more projections about where I think the business is going to go. The so-called simple ways of using averages and historical reference points for many businesses simply don't work for a lot of businesses in the income approach right now because the business has either had a significant decline or a significant increase in its cash flows. So what's this all mean to you? Well, depending on where you land on the spectrum, it probably means the process of valuation for your business, whether you're going out or coming into the business, is going to take more time. That's the main thing here. It's be prepared for it to take more time because the process of projecting where the business is going to go is a longer process. It takes more time than using historical averages when the business has just been flat for a number of years. What else? Be prepared to tell the story of where you think the business is going to go. So someone like me is coming in and helping you value the business. They're going to ask you where the business is going. How is it going to get there? So that last point is the one I really want to drive home. Be prepared to have actions that support the story you're telling. Okay? So you're in a dip. Let's say you've lost 50, 60% of your revenues, but you think you can turn it around. Okay? What are the actions you're doing that are going to support that? So then you can start to paint the picture of where the projections you think they're going to go up, right? In some cases, that may not be the case. Maybe the business will continue to operate at a lower level of sales. Maybe it'll come up somewhere in between its top end that it has been and where it is now. That's the story you have to tell, and you need to be able to explain the actions you're going to take on how you're going to get it there. This is some practical guidance on how to value your business during this difficult time right now. This is Josh Horn, CPA of Horn Valuation. Have a great day. Bye.